Let's talk about the hidden problems with target date ETFs or exchange-traded funds and why they might be a ripoff. I'm Dean Lolkin, investing veteran, private credit CEO, here to help you grow your wealth. Now, target date funds, both ETFs and mutual funds, are one of the most popular investment choices for people saving for retirement just like you. People in their 30s, 40s, 50s, 60s, and even to their 70s and 80s. Now, these funds promise a set it and forget it approach where the portfolio automatically adjusts over time. You're shifting from stocks to bonds as you get older. That sounds great, right? Wrong. In this episode, we're going to break down why target date ETFs might be one of the worst ways to invest for your retirement, especially if you're 40, 50, or 60. So, what's wrong with these target date funds? Sure sounds sexy. For one, they're one size fits all. It's a huge problem. Target date ETFs assume everyone retires at the same time and needs the same exact portfolio. So if we look at the Vanguard Target Retirement 2040 VFORX, if you're 40 years old today, you might think this is perfect. But Vanguard assumes you want a 90% stock and 10% bond portfolio now that should automatically shift to 50-50 by 2040. What if you want to retire earlier? What if you have other income sources? Too bad, you're locked into Vanguard's timeline. These funds also become way too conservative way too quickly. Most target date ETFs shift into bonds way too early for the vast majority of investors. They leave you underexposed to stocks when you still need growth in your portfolio. An example is the Fidelity Freedom 2035 Fund, FFTHX. If you're 50 today, this fund assumes you should start adding a lot of bond exposure already. What if you don't retire until 70? Now you've got low growth concentration way too soon, reducing your long-term wealth. Now, bonds may provide safety, which they certainly have in the last few years, but inflation and longevity risk mean you need stocks to grow. And a lot of times, these target date funds have hidden fees, even at Vanguard and Fidelity, which are great companies. Most investors assume big firms like Vanguard, Fidelity, and Schwab offer target date ETFs for cheap. But look at T. Rowe Price Target Date 2040, TRRDX. It's got a 0.64% expense ratio. That's anything but cheap. It's 21 times higher than just owning a simple 3-fund portfolio with ETFs. Now, they also don't account for other income or investments you might have, and a lot of you out there do. Target date ETFs don't know you, and they don't care if you own rental properties bringing in steady income, or you have a pension that reduces your need for bonds. And they also don't care that you might understand that short-term bonds pay as much or more than long-term bonds today. Now, you also might run a business, and you won't fully retire by 65. Again, target date funds do not care. If you have Social Security, a pension, cash flow from real estate, why would you need a fund that shifts into 50% bonds? These funds also force you into bad bond allocations. Most target date ETFs use outdated bond allocations that don't reflect today's marketplace. Let's look at Vanguard's Target Date 2035, VTTHX. A huge chunk of the bond allocation is government bonds, and they pay almost nothing. Very little exposure to alternative income sources like corporate bonds or notes, tips, or high-yield investments. My final verdict, should you ever own a target date ETF? I say no. I hate them almost as much as annuities. They overcharge for a simple mix of index funds, force you into a bad asset allocation based on age, not personal needs. And they don't adjust for real-life factors like rental income, pensions, or job security. If you see them in your 401k, please stay away. Have you ever invested in a target date ETF? I bet some of you have them in your 401ks or IRAs. What's been your experience? I want you to drop a comment below and subscribe to the Dean's List for more content on how to grow your wealth.